Okay, in this video, I'm going to teach you how you can day trade futures, even if you're a complete beginner. And I've spent years trading futures, years trading indices. I can honestly say it's probably the most simplest and easiest model that actually works, right? This actually works. I'm not just wasting your time for views. This model does work. So yeah, let's get straight into the video and let me show you what this model actually is. Okay, so the first thing you want to do is you want to get onto TradingView and you want to get onto regular trading hours, right? You don't want to be on electronic trading hours. You want to be on regular trading hours because what this does is it essentially gives you the 9:30 a.m. open. And this is a pro tip, right? Don't trade indices before the 9:30 a.m. open because it's just, there's not much volatility and it's just a waste of time, to be honest. And when you go on the regular trading hours on TradingView, what you get is you get the previous day's price action, right? And then it ends at 4 p.m. Now, this is a bank holiday, so it ends at like 1:15 p.m. But usually it'll end at 4 p.m., right? So right here, this candlestick, 9:30 a.m. And this will be from 9:30 all the way up till 4 p.m., right? When indices close. After that, we don't care about any price action. We only want to trade indices between 9:30 a.m. all the way till 4 p.m. Right? That's the first thing you want to do. And here's the pro tip, right? This is what all the pros do. Is they skip the first 30 minutes of indices, right? You don't need to trade the first 30 minutes because the first 30 minutes, it's a fake move, right? The first 30 minutes is a complete fake move designed to trick retail traders. And just look at this, right? So we consolidate for a bit. We drop massively. This drop here, let's make this a bit clearer, right? This drop right here, this is making retail traders chase price, right? Chase price because they think this is a breakout, right? They think the market's consolidated and bam, we broke out. So they're selling, right? Now, those who actually, are in know, smart money, those who know how to trade, what they're going to do is they're going to let this fake move happen and then they're going to buy and then they're going to ride price in the complete opposite direction, right? And, when I used to trade indices, I literally would buy like rightly open. As soon as there was any sort of movement like out, I would buy or I would sell, right? And there are so many retail traders who do this. So this is a fake move, right? 9:30 a.m. Eastern, all the way up until 10 a.m. Where is it around here? This is a fake move, right? 9:30 a.m. till 10 a.m. is a fake move. Now, the way you actually trade this is you wait until 10 a.m. Eastern, right? Just have some discipline. Wait till 10 a.m. Eastern. Don't even look at the charts until like 9:55 a.m. Eastern, because that's helped me out a lot, right? Don't even look at the charts because you might get tempted. Ignore the first 30 minutes, right? Because it's random, it's almost like gambling, and it's a fake move. Okay, so now that we've ignored the first 30 minutes, what we actually want to do for this trading model is we only want to look for our entry between 10 a.m. Eastern, which is here, all the way up until 11 a.m. Eastern, which is all the way over here, right? This is your golden zone. This is the absolute best time to trade futures because you get the first 30 minutes, which is a complete fake move, and then you get the real move, the real meat of the move, which happens 10 a.m. to 11 a.m. Eastern, right? So for this entry model, only trade between then. I'm telling you, it's such an easy, high probability setup if you only just focus on that time frame. And what you want to do, and this is so simple and it's so misunderstood, is you want to wait for the first fair value gap that forms on the 1 minute chart between 10 a.m., which is here, to 11 a.m. Eastern. Because that first fair value gap is very, very significant. All right, you don't often hear about this, but the first fair value gap that forms between 10 a.m. to 11 a.m. is very significant. Now, what do I mean by that? This right here is a fair value gap. Now, fair value gap is just, let me write this out. See this candlestick's high here, and this candlestick's low here. This forms a gap, right? This forms a gap. Now, why is that important? A fair value gap is essentially, its prices quickly moved in one direction. It quickly moved in one direction and had very little time to retrace, right? Because if there was a retracement like this, right? There was a retracement like this. Price would have quickly come down like that and come up. There would have been no fair value gap. We don't have that. What we have is price quickly, sharply, aggressively moves in one direction. It leaves the fair value gap. That is smart money. This entity who moves the market are telling us where price actually wants to go. That fair value gap is a massive hint for those who know, those who actually know how to trade, right? The fair value gap, it's a massive hint for where price wants to go, right? It's so important that you wait for that. So you wait for the first fair value gap that forms on the 1 minute between 10 a.m. to 11 a.m. Eastern, and then you just enter on that fair value gap. Right, it's as simple as that. You enter on that fair value gap, and what you're gonna do, enter on the fair value gap like this, put your stop loss at the swing low, like that, right? Always put it at the swing low. It's just a nice, easy. You don't need a really tight stop loss, especially on the 1 minute chart, right? And for take profit, you're gonna target at least a 2-to-1 or a 3-to-1 like that, like this, right? Like that, right? Like that. There's your 3-to-1. Nice, easy, high probability scalping model. And this is what I usually do all the time when I trade futures, right? This is such a great model. And there's actually another secret golden nugget that I'm going to tell you. So let me just remove this. You see this gap here? This is another reason why I like the regular trading hours. You see this gap that forms between Thursday and Friday's price action, right? We're completely ignoring all the price action that happened between Thursday the Friday, right? We only care about when indices were actually open. Now, you can see, right, just by looking at the charts, and because we've got regular trading hours, there's a big gap, right? There's an actual gap. This gap here, like this, right? This is what you call an opening range gap, because as soon as the market opened, this was the gap we have. This gap, and this is for your notes, this gap likes to get filled. Price does like to fill these gaps, right? So what I mean by that is what you usually get is you get the fake move, and then price will start to retrace all the way up, and it will fill that gap, right? It will fill that gap. Now, why am I telling you this? I'm telling you this because that gap can make a good entry, can make a nice entry. Now, I'm not, I'm a big believer in just taking a 3-to-1, but if you wanted to take, let's say partials, let's say half your position off a free risk to reward ratio, like that, you could hold all the way up until this gap here, until the gap gets filled for 4.67 risk to reward ratio. Now that's more risky if you want to pass a prop firm customer. You could do that, but just know that this gap here, this big gap here, does like to get filled. Price does like to refill these gaps, and then maybe it'll go the other way, but it does like to fill these gaps. And yeah, I mean, it's such a simple trading model, right? Wait for the first fair value gap that forms on the 1-minute chart between 10 to 11 a.m. Eastern. Enter on that fair value gap, aim for a 3-to-1, and yeah, you can be profitable now. Okay, so here we are on the Dow Jones, and like we always do, we wait for 10 a.m. Eastern. We completely forget about this move. We wait for 10 a.m. Eastern here. We wait for the first fair value gap that forms on the 1-minute chart, which is this fair value gap here, like this, like that. We enter on this fair value gap, like this. Put our stop loss at the swing high, like that. And then we target a 3-to-1 at most, or a 2-to-1. Alright, like this. So there you go. Nice, easy, high probability set. Now, this is why I'm a big believer in just at most aiming for a 3-to-1. Because if you aim for a 4-to-1, like, you just about get it. But if you keep aiming for, a higher and higher and higher risk to reward ratio, you're going to miss out. Especially for indices on the 1-minute chart. Like, at most, aim for a 3-to-1. Or at least take partials, right? So 3-to-1, nice and easy. Easy, high probability risk to reward ratio. But a 3-to-1 risk to reward ratio is perfect, like that, right? Like that, if I can get it right. Like that, nice and easy. This model works, it works so good. Like, it works so good, right? Ignore the first 30 minutes that indices open. Wait for 10 a.m. to 11 a.m. Enter on the first fair value that forms on the 1-minute chart. Aim for a 2 or 3 risk to reward ratio. And I don't know if you can make futures any more simpler than that, but this model works. Backtest it, try it out, and yeah, have fun with this. Now, obviously, if you want to increase the win rate and stuff, having the higher time frame direction, all that sort of stuff will help you. And if you're struggling with the higher time frames and all that, I've got a course in the link description below which explains all of it in much more detail. But other than that, make sure you like, subscribe, and leave a comment. Let me know what you want me to cover next. And I'll see you guys next video. Peace.